Hello students, welcome to today's economics lecture. Today we'll explore the tools used by central banks to control credit in the economy. Open market operations, or OMO, is the purchase or sale of government securities by the central bank to increase or decrease the money supply. This tool is used to regulate interest rates and inflation, bank rate or discount rate. The bank rate is the interest rate at which commercial banks borrow from the central bank. This rate influences the prime lending rate and overall credit conditions. Reserve requirements or cash reserve. Ratio reserve requirements refer to the percentage of deposits that commercial banks must hold as reserves rather than lending them out. This tool controls the money multiplier effect. Repo rate or repurchase rate. The repo rate is the interest rate at which commercial banks borrow from the central bank for short-term periods. This rate influences the money market rates. Reverse repo rate. The reverse repo rate is the interest rate at which commercial banks lend to the central bank for short-term periods. This rate influences the money market rates. Qualitative weapons of credit control. Qualitative weapons include indirect tools used by central banks to influence credit allocation and lending practices. These tools are used to address specific economic concerns and promote sustainable economic growth. Margin requirements. Margin requirements refer to the minimum margin required for loans, especially for speculative purposes. By increasing margin requirements, central banks can reduce speculative borrowing and prevent asset bubbles. Credit rationing. Credit rationing involves directly controlling the amount of credit available to specific sectors or industries. This tool is used to prevent excessive borrowing and promote sustainable economic growth. Moral suasion. Moral suasion involves persuading commercial banks to follow certain lending practices or guidelines. Central banks use moral suasion to promote responsible lending practices and prevent excessive risk-taking. Selective credit control. Selective credit control involves targeting specific sectors or industries for credit control. This tool is used to address specific economic concerns, such as preventing asset bubbles or promoting sustainable economic growth. Directives involve issuing formal instructions to commercial banks regarding lending practices or credit allocation. Central banks use directives to ensure compliance with monetary policy objectives. Case studies. Let's consider some case studies to illustrate the use of qualitative weapons of credit control. Conclusion. In conclusion, qualitative weapons of credit control are indirect tools used by central banks to influence credit allocation and lending practices. These tools are used to address specific economic concerns and promote sustainable economic growth.